What is going on, guys? I hope all of you guys are doing absolutely great. So if you've been following the markets, last week the Dow Jones had one heck of a ride. And I think it was on Wednesday that the Dow tumbled as much as 700 points, which was the most that it has tumbled in one single day since February. So guys, in this video, I want to talk about why I personally think this happened and why going forward, I think it is going to continue happening. And I'm also going to talk about what I am personally doing with my portfolio so I can be in a defensive position and benefit if the market does pull back. But real quick, guys, it would mean the world to me if you guys could just quickly like this video so other people who have a passion for value investing get to see this video. But otherwise, let's get right into it. So last week I was at work and I felt my phone vibrate in my pocket, and my friend had texted me asking if I had seen what the Dow Jones was doing. And I quickly looked at what the Dow was at, and it was down 700 points. And honestly, I had no reaction. I just put my phone away and put it back in my pocket, and I really wasn't that shocked or fazed by the massive movement, and here's why. So guys, it is safe to say that our economy is on fire right now. In fact, our country's GDP, our gross domestic product, or in other words, our country's ability to efficiently produce goods, rose by 6.4% last quarter alone. But what is even more interesting than the GDP metric is that consumer spending activity has been increasing dramatically too. Also, business investment activity has been increasing. So this means businesses have more money to deploy into hiring, getting more property, plant, and equipment, and essentially being more efficient. And additionally, another thing that I find personally really interesting is that residential home construction has been increasing too. And this seems to indicate, at least for me, that people have the funds to purchase more property. Now, of course, this is all really great news, right? We like seeing this kind of stuff. And who knows, maybe this will all be the catalyst for yet another great second quarter and maybe even a third quarter. I can't predict the future. However, I do know that there are a few things that as business owners and business investors, we need to begin thinking about. Now, one of my favorite quotes from Howard Marks in his book, The Most Important Thing, is history doesn't repeat itself, but it does rhyme. And I actually think this is really relevant considering where we are at in the market cycle. I mean, guys, I will be really honest. I am actually a little concerned with inflation right now. I mean, I don't let it ruin my day or anything. However, it is something that I think about. Of course, last year, as you guys may have known, the Federal Reserve let the cannon loose and decided to print money like there was no tomorrow. Now, this probably had to be done considering what was going on last year and did benefit us in the short term. However, it can't go without saying that in the long term, there most certainly has to be repercussions for what we did. So something that I have been thinking more and more about recently is the Consumer Price Index. So what the CPI tells us are the changes in price levels of consumer goods. So for example, guys, if the Federal Reserve decides to lower interest rates like they did last year to astronomically low levels, then the cost to borrow money throughout the rest of the economy is going to be a lot cheaper. And that means that there are going to be more dollars circulating throughout the economy. Now, while these low interest rates are great for individuals who are looking to take out loans or maybe buy a house, it does mean that there are going to be more dollars in supply. And when there are more dollars circulating in the economy, obviously the value of the dollar goes down. So what does this mean? Well, it means that the prices of everyday consumer goods and services are going to go up because it's going to take more dollars to justify the price and the value being offered. So what does this mean for you as the end consumer? Well, essentially it means that your purchasing power is going to diminish. Or in other words, it's going to cost more just to live. Now, of course, you could argue, well, Jake, what if my job gives me raises that adjust for inflation? And I would come back to you and say, you are really smart, because that is a great argument. In fact, since the 1980s, the supply of money has been dramatically increasing and the moving average of interest rates has been going down. And contrary to popular belief, the country has only prospered. America has done very well in the past 40 years. However, I would probably argue back and say that we are in a different time. You see, we've never seen interest rates this low for this long, and we've never seen this much stimulus injected into the economy in such a short amount of time. And guys, when interest rates and all of this stimulus have been going on for as long as they have, one can only think about the historical accounts of Japan and their downfall downfall due to hyperinflation during the early 90s. Now, I don't mean to scare all of you. I honestly don't think we are going to end up like Japan. However, I do think that eventually we are going to have rubber meet the road, and the Federal Reserve will have to decrease the supply of money by increasing interest rates. But what do increased interest rates mean for stocks and businesses? Well, essentially, the cost to borrow money and conduct business operations increases, which means that the bottom line is going to be impacted. It also means that businesses are going to have a significantly harder time competing because they're going to have less funds to contribute to research and development, hiring new people, and purchasing property, plant, and equipment. Now, historically speaking, when interest rates rise, stock values go down. And this isn't because the businesses have all of a sudden decreased in value. I mean, businesses are not just going to change overnight because interest rates went up. However, the market tends to overreact and they start to panic. And we actually might have seen a bit of that last Wednesday when the Dow tumbled 700 points in one single day. Now, I do want to say that the Federal Reserve has come out and said that they have no intentions of increasing interest rates, at least dramatically in the short term. However, eventually, like I said earlier, rubber is going to have to meet the road simply because of supply constraints and a significant decrease in consumer purchasing power. Now guys, right now the average PE ratio of the S&P 500 I think is around 44. And this is really high considering historically speaking over the last century, the average PE ratio has sat around 15 to 20. What this tells me is that the vast majority of the market is overvalued and that most investment opportunities are probably pretty risky. However, to tell you the truth guys, I am really excited for a market crash, and here's why. So for the past 7 months, guys, I have just been piling up cash left and right. I think I'm at about 34%. And the only reason that it is so high, I mean, I don't like having high cash levels, guys, but the only reason I'm at that level is because I simply can't find any opportunities here in the US. Now, yes, it is definitely true that I have made a few investments this year. However, for the most part, these investments have all been in other countries where the average valuations of those markets are considerably less than what they are here in the United States. Now, like I said earlier, guys, right now I am over 30% cash levels in my portfolio. And of course, I do not want to stay here for too long. However, I do think this is a comfortable place for me to be in case there is a market correction. Additionally, I should probably note that I have begun selling off stock in companies that have reached ridiculous PE ratios and business valuations. So the last thing I want to mention, guys, is that I honestly really don't give much weight to what the market's doing. I definitely find it interesting and entertaining from a human behavior and psychological point of view. However, I really don't like giving it much of my time because I prefer to spend my time in other ways. For example, I would rather spend time looking for undervalued opportunities. The only thing the market is going to tell me is how hard I should be looking for these opportunities. I mean, guys, when the market is this frothy and this astronomically high, I know it's in my interest to just do other things like read books, be educated, watch other YouTube videos from other channels to stay in the loop, and keep piling up cash. Because when the market does correct itself, I will be in a great position financially with all the cash that I've saved up and from a mental point of view to benefit from the market downturn. So anyways, guys, even though we are in a market that is extremely volatile, my advice to you is just not to freak out too much. Watch it, assess it, be entertained and engage with it, but don't give it any weight. Anyways, guys, you are awesome. Thank you so much for taking the time to watch this video. I will see you guys all in the next video.